Our Way Nation, what is going on? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. I welcome each and every one of you to the Financial Power Hour. You know, we changed the format up this year. We still do 15 minutes of finance on Tuesdays and Thursdays, but on Wednesday night, we give a whole hour to the topics that matter most to you. And tonight, the theme of the week is student loan everything, student loan debt, student loan forgiveness, student loan applications. If it's about student loans, we're talking about it this week. But tonight, I have a friend of the program, I can't even use enough adjectives to describe how brilliant and knowledgeable this woman is. We have Dr. Genevieve Dobson with us. I call her Dr. Jen. Dr. Jen, welcome to the program.
Hi, thank you. I appreciate it. So excited to be here.
We love having you here. Before we get into tonight's, ins and outs and ups and downs, let me do as I always do and practice the attitude of gratitude and thank each and every one of you who are here with us as we stream across the Wealth Our Way Facebook and YouTube platforms. I also want to give the Wild Nation salute to all of the members who will watch this program pre-recorded overnight, over the weekend, wherever they can get their hour power together. And then lastly, the good folks on the Life 101 platform who will listen to the audio recording of this very here program. I also encourage each and every one of you, if you do not currently follow Wealth Our Way on Facebook, subscribe to the YouTube channel. It's at Wealth Our Way everywhere you can locate it. So let's just jump right into it because it's my experience now. This is our fourth Power Hour, and the first three, before I knew it, an hour was gone. When I first set this format up, I was like, man, an hour, how am I going to fill an hour? Are people going to stay attached for an hour? It goes by so quickly, so I don't want to be too long-winded. I want to get right to the goods. Before we start asking questions, taking questions from the audience, let's give the people a little background on all things Dr. Jen.
Sure. I got a lot going on at the moment. So I am an entrepreneur. I actually own 3 businesses. One of them is a student loan management and credit management company called Degrees of Success, which we're going to talk about today. I also do business consulting, and I have a property management and investment company as well. We do a lot of like Airbnb arbitrage, so I have that going on. I am a professor this year, my first year. I'm so excited. It's just fun. Like I get to teach business. So I get to teach young minds about all kinds of cool things in entrepreneurial efforts. So I have that. I am a coach at University of Tampa. I am a 3-time author as well and a speaker. So I
told you she was well decorated. So, with that being said, I want to talk about real quick, just touching on before we get into the subject matter, being a professor. I applaud you for that. A buddy of mine and I were talking about how so many schools nowadays, universities and colleges are going to with the way they always should have done, which is having people who are actually out in the fields who know the ins and outs of a particular topic, teach it to the young minds, because there are so many people in higher education who are great at the art of teaching, but they're short on actual practice. So it's great to hear that you are taking your entrepreneurial experiences from the real world and carrying them over to the classroom.
Thank you. I appreciate that. It's definitely important.
No worries at all. So let's get to the subject matter at hand. We're talking about student loans and forgiveness. There was a lot of news a week and a half ago about the Navient settlement. I want to talk about that. I want to talk about the continued extension of deferring payments for right now. But let's just start getting into in your mind, what is the current state of student loan conversation in this country?
Ooh, well, look, I'm going to be blunt here. They have no idea what they're doing. Maybe the government is listening. Y'all know I'm not lying. It's a mess. So there is a lot of things going on in the back end, a lot of lawsuits that are happening. They don't necessarily advertise them as that, right? It's like, oh, look what we're going to give you. We're going to give you something. No, those were lawsuits, and there are settlements that are coming out of that that's forcing them to make a change. So the big one that everybody's been talking about recently, Navient got sued as usual. Keep in mind, Navient is really Sallie Mae. Sallie Mae and Navient are the same. Sallie Mae got sued so many times that they ended up changing to Navient. People don't realize that. People are like, oh, well, Sallie Mae's kind of gone. No, it's the same. They're the same. They just opened a new organization. So Navient got sued. And the reason they got sued is because Consumer Protection Bureau came out quite a few years ago and said, hey, we know that these student loan servicing companies are purposely and fraudulently mismanaging student loan borrowers' accounts. Like, I mean, let that sink in. Like, we know that they are illegally mismanaging. So if you call and you're like, okay, this is my student loan company and they're going to help me figure out what I got to do. I don't know what to do, right? I got to call. Okay, I can't afford this payment. What do I do? And you know what they did? They were like, oh, just do it forbearance. Oh, just do it forbearance. Oh, just do it forbearance. Well, the problem with that is that so many people could have done income-driven repayment and they'd have forgiveness by now. Literally, student loan forgiveness. But they said that the reason they didn't do that is because it was easier. But what they found in the lawsuit is what actually was happening is they were training their customer service reps to get people off the phone as quickly as possible, right? Get them off the phone next, get them off the phone next. It was all their quota. And therefore, they were told, like, hey, just give them a forbearance. They can't pay, just give them a forbearance and keep it moving without looking at the ramifications of what that happened. Millions of people did not get forgiveness because of that.
Wow.
So that's one of the big things that's occurring with the whole Navient lawsuit. Here's the problem, though. So that's with federal loans, okay? So that's what was happening with federal loans. And there's a misconception because people think that somehow federal loans are being canceled. That's not the case. They're giving $260 roughly to some of those people in those situations. Dollars.
$262?
$260. No, not even $2.
$260.
$260 is going to go to people that were in that situation.
So now, when you see the big headline that says Navient forgiven $18 million or whatever the number was, that's just like a class action collection of $260 payments?
Well, yes and no. So a portion of that is the class action for federal loans, but a portion of that is actually for private loan cancellation. Now, that's a much bigger story, but the headline they're not clear, right? So those people that have private Sallie Mae loans that may or may not be serviced by Navient, more than likely they're actually still under Sallie Mae, but those loans could potentially be canceled. But that's going to be for people that went to for-profit schools like Everest University, ITT Tech, even like I think DeVry is in. Yeah. So those different schools that we know were purposely getting people in. I used to work, I almost hate to say it on live. So I used to work for a company that we managed Everest accounts, among others, right? And they definitely got shot down. And what they were doing is they were lying about job placement numbers. So they were getting people in the door like, oh, come to us. We're going to help you get a job. No, they were getting people in the door that already had jobs, and they were using those job numbers as their job placement numbers.
Wow.
Yeah, right? So there was a lot of that was going on. Also, what was happening with Navient and Sallie Mae is that they were going to schools, and they were saying, hey, if you use our private loans, because schools have to have a certain number of private loans in order to then get federal funding.
Okay.
So they were going to school like, hey, we will give even your borrowers who wouldn't normally qualify for private loans because their credit is bad, they don't have any income. We're going to still fund them. And as long as you back it and guarantee it for us. And then by doing that, you're going to tell them to use us for the servicing platform for the federal loans. Right? Shady stuff. So, okay, we have to get private loans in order to get federal funding. So we're going to go ahead and get in bed with Sallie Mae, even when borrowers shouldn't have had private loans, by the way. They should have had federal loans. But we're going to go ahead and get some people to sign up for those so that we can then turn around and get our funding. And Sallie Mae's willing to take the hits because they're going to get their money on the federal side.
Right.
Lots and lots of fraudulent activity.
Let me ask a question. A lot of the people who watch the Financial Power Hour are from an age demographic. They're paying back student loans. They're adults. We're 40, 45, 50 years of age.
Right.
Conversely, though, the same audience have children who are about to go to college or who are in college. So one of the things that I have had my eyes open to, and you touched on it with the hustle between private loans to federal loans, I think people fail to understand the relationships and the abuse of the universities themselves. The reality is, so I'll use myself as an example. Everybody who knows this program knows I'm always throwing my business out here. I graduated from high school, or I left high school is the better term, in 87. So I went to college in fall of 87. I ended up graduating from the Great Temple University in the winter session of 95. So It was almost 96. So it took me 9 years from the time I left high school to complete college. I was in school, I was out of school. There was a bunch of things going on.
Right.
There was never a time I couldn't get a loan. There was never a time I couldn't incur debt. And it also, and this is the part that I say where the schools are complicit in this hustle, the schools don't dismiss you as quickly as they should, so to speak. If you are not on pace to graduate and you're not keeping up with your academics, it still behooves them to keep you in, let you get a loan, and pay their tuition. We have seen, and I know I'm probably taking some of your thunder, so by all means, clear to catch me up on it after I finish this. We've seen the rise in college tuitions lock in step with the subsidizing of federal loans. So once it became a thing where every lender could have the loan subsidized, colleges started ranking up the actual cost of school because they knew they would get their loan money. And we also saw a drop in the amount of private college endowment money that was going to students. These endowments are growing and they're huge and they're supposed to be to help students who can't afford school. But instead of getting the endowment, they're pushing you the loan route. So let's talk a little bit about that kind of cohesive collusion, so to speak.
Yeah, I mean, you're absolutely correct. I mean, there's tuition has gone up. The last time I looked, like 58% in the last 10 years. But of course, as we know, income hasn't gone up that much.
Correct.
So there is, the schools are getting paid the tuition money. They know that it's going to be federally backed and guaranteed. They know that they can get the funding as long as the student does certain requirements. There's some requirements, but it's pretty easy to show that they're doing those things. And then the schools make this large amount of money. They don't recommend that some students don't go to school if they see that maybe they're not right on the path to do that. They just say, well, hey, you want to go to school? Here's a loan for you. Take out the loan, go to school. Perfect. And in a lot of cases, because I deal with a lot of parents that come to me and say, hey, we need help with our students, with our child's student loans. And a lot of times I literally have had clients where I said, listen, you can't afford this school. You can't afford this school. There's other things that you might want to look into. Maybe start them off at 2 years of community college.
I preach that here on this program. We did a whole thing on this last year on the cheapest way to obtain a 4-year degree. And not only is starting off at a community one of the things we recommend for pricing, it's also one of the things we recommend to getting a better degree. Because when I say a better degree, from a higher rated university, because one of the little known hacks for getting into college is colleges are the most difficult to get into leaving out of a senior in high school. So the incoming freshman class is what all of the rankings are based on. Once you become a transfer student in after freshman year or after sophomore year, those rankings don't matter to the university. So Harvard would let you in as a transfer from community college faster than they would let you in from a high school with damn near a perfect SAT score.
Right. Yeah, it's a lot harder. Absolutely. Absolutely. And it's important too, because, from 18 to 20, do you really know what you want to do? A lot of people change over and over again. Now they've paid for all these classes, and then they realize that's not what they want to do. And so there's a lot of adjustment and regulation changes that need to happen on the institution's level. And I wrote a lot about this in my dissertation. I wrote my dissertation on student loan management, some of the pitfalls and downfalls, and looking at institutions as well as other things when we're deciding how we're going to make adjustments to the student loan industry as a whole. And the colleges do have to step up and say, okay, we have to own some of this, right? Why am I letting somebody go and get a social worker degree, but I know that they can't afford the cost of tuition when they get out because they're not going to make enough money in that field. So that might be something where they say, well, in order to do this, you have to come in and be able to afford the tuition beforehand. Like, if that's what you really want to do, great. Pay for it out of pocket. Let's see how vested you are. And then that way, if you want to get into the social work environment and make $30,000, $40,000 a year, that's great. But you don't have $60,000, $70,000 in student loans to, combat. So there's definitely a lot of changes that need to happen.
That's a very valid point. There's so much mismanagement in the course and career guidance side of universities these days. Exactly, putting someone else into a field. I saw it a lot when I was younger and in college at the liberal arts schools. They tend to be higher tuition and give you majors that weren't making a lot of money, art appreciation and, music appreciation, and you're paying $47,000 a year to go to Fisk or, something like that.
Exactly. Yeah. So there's a lot of laws that I think could help with, those type of issues, so it's got to be collective. The government has to come in and say, okay, we're going to make adjustments to who we allow to get student loans. And the schools have to come in and say, hey, we want to be better at serving our community. I mean, I remember, pre-COVID where I would contact schools and say, hey, I'm a student loan expert. Let me come in and do a free event where I can teach the students about different types of student loans, make them more aware of what their options are, what to expect when they get out. And a lot of the financial aid office would be like, no, we got it. We're good. And I'm like, no.
Yeah, we don't want them to have that kind of knowledge,
Right. Yeah. It's like, no. And I'm like, no, you're not experts. You're financial. Yes, you might work in the financial aid space, but 9 times out of 10, they're not student loan experts, but they don't want to hear it.
Let me bring a couple of the audience questions up. So my guy Arion has said that he has his loan through Nelnet. Nelnet is also the provider for my daughter who went to Georgia State. And I encouraged all of my kids from a cash flow from my standpoint, for me, take the loan out, I'll pay the loan. The rates are just so infinitesimally low. My money would be better working in the market. And Nelnet is also my daughter's service provider. First, is Nelnet a private or a federal loan lender?
Well, they're not a lender; they're a servicer.
Servicer, okay, perfect.
Yes. So, and there is, and I'm glad that I'll say this real quick. So, there is a misconception about who the lenders are for student loans.
Okay.
So people will say like, oh, well, Sally Mae sold my loan, or Navient sold my loan, or Nelnet. No, these are companies that are hired by the government to service the account. They send out the billing, they collect the money, they get a fee for it. So Nelnet services federal loans. Generally speaking, there are some private loan options. A lot of the servicing companies can do federal and private, but generally speaking, they're going to be all federal.
Okay.
Okay.
When we talk about the FFEL, and I was talking to you off the camera about the difference between FFEL and FFELP, and I just read the article a little bit myself, and they said it's really the same thing, just the P is for programs.
Right.
What are some of the things that we need to be on the lookout for if we have what is an FFEL loan, and what are some of the things that you can tell us to be helpful for those of us who have to pay those back?
Absolutely. So FFELP loans or FFEL loans, like you said, they are basically the same. These are going to be our older loans for me and you, our age group, right? So those of us that did start school prior to 2007, we would potentially have those loans. Now, what happens with FF, that's Federal Family Education Loan Program. Now we have the direct loan program. So before, under FFEL, you did have private lenders that would lend the money for the tuition, and then the government would back or guarantee it. Now the government lends the money. It's coming directly from the Department of Education. So that's the difference. Okay. And some of the important factors to that now is that when we look at FFEL loans, they do not qualify for a lot of things. So for example, many of us that do have newer loans are getting zero interest, and we don't have to make payments. FFELP loans do not fall under that, which means that if you still have FFELP loans, they need to be consolidated. But you must be careful how they're consolidated. And I tell people all the time, they're like, oh, I'll do it myself. Okay. But it's important because you may not necessarily want to consolidate them all together with your new loans. Generally speaking, FFELP loans have lower interest rates, generally speaking. Some of your old 86, 87 loans might be higher, but you're right. But you're like 2000, 2001, 2004 loans are going to be much lower because they're still varying rate loans. And the rates are really low. You don't necessarily want to blend that with your higher rate 6.8, 7.2 loans. So there's a lot of things that you want to understand, but the key right now, because it's January 26th until May 1st, there's zero interest, zero payments. If they're not consolidated, they still need to be. And for those that are expecting public service loan forgiveness, those do not count. But under the new public service loan waiver, they are giving everybody until October, which is right around the corner, because it takes them forever to get these consolidations to go through. But you can consolidate them and still get them qualified for forgiveness under that program.
Let's talk about forgiveness, and I'll go back to another question that's in the chat. Yeah. Because my family member is in public sector. Okay. Has been in public sector for 5 years. Okay. But never started the process for public service loan forgiveness. Uh-huh. In a situation like that, what does somebody do? Because they say you have to work for 10 years in the public sector. But if you've been getting forbearances, because every time you called, they told you to forbear. What is the process for people to get caught up? Or is it, hey, sorry, you should have started 5 years ago, but you're going to start today now? How's that work?
So I'll give you two answers because the government is a little shady. Technically, the way it's supposed to work is under the new waiver, you can reapply. And even if you were not in the right payment program, your payment should, though that time that went by technically should count towards qualifying. Okay. So technically. However, I will say this. Do I think the government will, in 10 years from now, give people forgiveness in that situation? I would find it hard to believe, because here's what I'm finding. Even my clients, some of them that should qualify, it's a big fight. It's doable, but it's a big fight because what's happening is they're saying like, well, they should have qualified, and if they were in some level of repayment, we'll give it to them. But if they weren't really in repayment, we're not going to give it to them, even though we know that they were fraudulently mismanaging, therefore not putting them in repayment, and they didn't know. So there's a lot of gray area. So I want to say technically they should be able to requalify, get that time to count, and then move on for another 5 years and get forgiveness. But I think there's going to be some gray areas where in some situations, they're not going to give it to them.
Got it.
But I will say it behooves them to try. Right. I do have clients that have gotten forgiveness. We fought for it. We got it. Where they would say like, oh, well, no, they need more time. And I'm like, no, they don't. They've done their time. Let's do it. I have a client, Sarah. It was like $180,000 in forgiveness. She's done. I have other clients. They're done. But it is, so If somebody hires me to do it, we will fight for it. I can't 100% guarantee that they'll get it, but we've done very well track record wise of being able to prove that they should have qualified and that there was either something fraudulent going on with the lender or there was miscommunication that didn't allow them to get it. But their role, their position shows that they should have gotten it. And there's some steps. So we do consolidation, get those FFELP loans qualifying, and then we go out and we fight for it. And there's a lot of paperwork involved in that process.
Understood. Couple of things you brought up. So I'm going to say this and get it out the way so we can go right back to pure student loans. But I got to talk about the economy and the financial ramifications of mass forgiveness, because whereas I want everybody to prosper, I do. Everybody who knows me knows I want everybody to prosper. I am still a child of capitalism. And as a result, I understand that we got to pay for things that we use. And waving a magic wand and blanketly wiping out a whole sector of debt is bad for the economy at the end of the day. And so I've seen.
I disagree with you.
How so? How so? Well, we should talk about that, because the reality is we already have all of the stimulus that has happened from the CARES Act and the various COVID provisions. We are seeing hyperinflation. And shameless plug for Charles Tank Harris and Wealth Our Way. I've been telling my audience since the beginning of last year to be on the lookout for hyperinflation based on the over flooding of the market with new dollars. If we're going to be in a situation where we literally just wipe out a whole sector of money that the government is expecting to collect, where will they go to collect it? They'll go to collect it through increased taxes. They'll go to collect it through putting more money into the system and thus making our debt less attractive for other countries to purchase it because our interest rates will be so low. So I think that has to be done with some level of judiciousness. And then I'm just going to be a hater. My loans got paid. So I don't want to see everybody else getting forgiven and I paid mine. Are they going to come back and get Big Tank a check for the money I paid doing mine the right way?
Listen,
so I'm a hater in the house on
now, you can't be selfish here, okay? Now, so I understand what you're saying. I do. And there is a big argument about which way is the right way. But let me break a different side of it down. So number one, the government has been making billions of dollars in tax money from interest alone, right? And like I mentioned in the beginning of this conversation, we know that they have been fraudulently mismanaging borrowers, which is now costing borrowers more money, which means they've been making even more money than they should have been. So when we look at even just that, right? And I'll get into the whole, like, what's going to happen in the future. When we look at just that and we look at how much money they've actually been able to produce from the backs of students that shouldn't have been charged what they were, shouldn't have been allowed to take out the loans, shouldn't have had all the late fees, interest, and this and that and the other. Just that alone really does kind of cover the cost. But now if we look at it though, moving forward, and we say, okay, well, yes, okay, they still expected a lot more money and now they're going to try to waive it. Number one, that's not going to happen. They're not going to waive all student loans. It's never going to happen. But number two, what happens in the economy when we allow people who are struggling to spend $500, $600 a month? What happens when they have that money? What generally happens, right? They put that money back into the economy. So it's not like the money is just poof gone, right? The money just doesn't disappear. It just moves from one hand to another. So what will ultimately happen, and what we see happen, especially in middle class and lower class communities, is that we spend our money. And so that extra money that people are struggling to buy houses, people are struggling to buy cars or upgrade their cars, people are struggling to do anything, people are struggling to pay for financial services, right? Gosh, if somebody has an extra $1,000 a month and now they can invest in in insurance, that's huge, right? So that money will come in, because if I have an extra $1,000, I'm like, oh, let me start investing. Let me buy some stocks. Let me do something. That money will come back. So I don't think that we're going to be in a position where, oh, poof, it's gone and the economy is going to tank. I think we're going to see consumers are going to start buying more and spending more because they're going to have it to spend.
See, and that's why you're Dr. Jen. I wanted to hear the devil's advocate to my position. I actually have a debate with a relative all the time about that very topic, and you touched on it. She says that the only people who should be required to pay back their student loans are people who didn't finish their degree programs, because those people who finish their degree programs, as you say, are out contributing to society, paying tax dollars on an increased income because they had to get this job. She even actually, and it was a great argument, we had a lengthy debate about this. She actually brought racism, and we all know that the student loan predatory practices have affected brown and black people a little more than other classes of Americans. Mm-hmm. But she brought the racial element in a way I had never thought of, and I consider myself a great thinker. So she caught me off guard. She said, listen, for me, and she brought gender in as well, for me as a black woman to compete with my white and especially white male counterpart in the workforce, I have to continue to get the same degrees that he's going to have. And if it takes me alone to get it, but because for generations my people have been oppressed and we don't have inherent wealth in our home, but he didn't need to get a loan because his dad or grandfather paid for him to go to college, there's once again that competitive disadvantage, because I'm going to be at the same job, probably not getting paid the same, but that's a whole nother issue about gender and race payment equality.
Right.
But I'm going to have the same title, the same job, and let's just hypothetically say the same income, but I now have $100,000 in debt that he didn't have to get there. So I do understand, and I am sensitive to your argument about it. I like to, on the show, of course, antagonize to point out from people to say why they think the other side is right.
Right. And those are some really good points. Now, I will say too, though, she made a lot of great points. I will also say, though, that those that didn't graduate, most of those, again, going back to the fraudulence, were going to universities or colleges or for-profit schools, and they were bamboozled into particular programs that they never finished.
Yes.
And of course, a large majority of those are going to be ethnic minorities, right? So, to say that they should pay them back because they didn't finish college, there's a lot of reasons for that too, right? There's a lot of reasons. Every school literally marketed specifically to Black and brown people to get them into the schools, and they would lie about the degree or the certification that they were going to get. So, is it fair for them to pay back the loans? So there's definitely a lot of sides to it for sure.
What I want to do, I think, and this is probably, so I commend you. First of all, the topic is hot and everybody wants to talk about it. But this is the fourth program we've done this year, and I've never had as many questions in the chat for the other three programs. And we did cryptocurrency, and cryptocurrency has people head spinning. But I want us to probably spend the rest of the program. I think we could spend the next 27 minutes just answering questions. And I love the support I get from the audience, so I don't want any question to go unanswered. So I'm going to scroll back up to, I think it was Tashawanna's question, where she asked, please talk about the different types of loans that are out there and what initials I need to look for on my paper. For example, PLS plus loan.
Okay, yeah, so that gets challenging. So we have our old FFELP loans that we talked about. Different servicing companies might list them slightly different, but as a whole, the difference between the FFELP and the direct loans is the word direct. So if you see direct, or if you see Department of Education listed, then you know that that's a newer loan program.
Okay.
So it'll say like a direct subsidized loan, direct unsubsidized, direct grad plus loan, direct parent plus loan. Those are going to be kind of your standards. An FFELP loan doesn't normally say FFELP. It usually just says subsidized, unsubsidized. Sometimes the consolidation will say FFELP consolidation. Sometimes it just says consolidated, or consolidated subsidized, consolidated unsubsidized. But generally you're looking for either direct or Department of Education versus not. And that's going to kind of give you a clue as to whether you have some of those old loans. And if you do, those are the ones that need to be consolidated for sure. And they might need to be consolidated with the new loans, depending on the type of loan, or it might need to be consolidated slightly.
Perfect. Okay, so Tamiko has a litany of questions, and I will mix them in with other people's questions. Her first question from earlier was, with the current government adjustments on student loans, should these FFELP loans even be repaid right now, or should we be in a wait and see what happens mode?
Well, so the FFELP loans technically need to be repaid. So especially those, I mean, so we look at those versus direct loans. Direct loans are currently wait right now until May, right? No payments until May. The thing I always remind people, you have to make either a payment or you have to make sure that it's in a qualifying payment program. Don't just default or just, I got plenty of people that are like, yeah, I haven't paid in 8 years. What do I do? I'm like, who told you that was okay? Like, no. But so wait and see mode. It's a good question. I would say I wouldn't necessarily pay off all the student loans, but I never recommend that anyway, even prior to the possibility of cancellation or forgiveness. The key with student loans is that they're simple interest loans. You're going to want to be investing your money in compound high bearing interest platforms, whether it's insurance or whatever. And obviously they can talk to you about that versus paying off debt, because yes, debt is important to pay off, but there's no rush to pay off student loan debt, especially if we're talking federal loans. Private loans are a little different. So pay what you're required to pay, and anything extra you have should be invested. That way you can kind of offset the overall cost. If you look at how much you paid in student loans over 10 years versus how much you can make in investments over 10 years, you're going to make more than what you owe. And that's going to be the key. You know, I know there's this emotional thing, and people that follow Dave Ramsey, which please don't follow Dave Ramsey.
Thank you.
Oh gosh, please don't. But those that do, you know, there's this thought process of this emotional connection to debt. You got to let that go. Let it go. Emotions and financially advantageous are two different things. Don't pay off the student loans faster. And there is a possibility of potential cancellation in the future. If I had to make some guesses based on my 16 years, almost 17 years of experience, I would say that we probably will see some level of forgiveness. It's not going to be a large level, but we'll see some level of forgiveness before Biden exits the presidency. So I would anticipate something to come out of that. And then we'll see what happens, of course, through the next election, if there's even further forgiveness. But this is a big push. Elizabeth Warren is pushing for $50,000 for everybody, and she has reason. I mean, her numbers, her analysis makes sense. I mean, it will literally close some of the racial and ethnic inequality gaps. And of course, women as well. So when we look at minority gaps, $50,000 will come in and start to close that. So a $50,000 forgiveness for everybody would be ideal. But will we see that? I don't expect it. I think maybe we'll see 10,000.
Okay, let me interject, because I said I was going to just do questions, but me and you talked about a point earlier that you just talked about and brought up. When we say what's the rush to pay off student loans, you make a very valid point about the difference between simple interest and compound interest. But one of the problems with having student loan debt is your debt to equity, debt to income ratios when you're buying a house. And you told me earlier before we got on the program that there have been some changes to FHA as it pertains to buying and getting mortgages with student loans. Can you touch on that real quick?
Yeah, absolutely. So a good thing that came out of all this mess. So before, what was happening with FHA is they were saying, if you have student loans, and let's say you're not paying them, you have them in forbearance, which don't do that. But you have them in forbearance and you're not paying them. What FHA was doing is they're saying, well, we don't know what your payment is, so we're going to assume it's 10% of your balance. Well, if you owe $200,000, that's $2,000 of monthly debt. That's a lot. Now, they've come back and said two different things now. So either they will go off of the actual payment you have. So let's say you're in an income-based repayment, you're in a graduated payment option, which, keep in mind, I can make it look pretty for the mortgage company no matter what they want, to give them what they want, get the lowest possible payment. They will either go off of that, or if you're not paying, they will only go off of 0.5%. So it's a little bit better. You know, student loans, of course, do have an impact. You can have a large amount of student loans, though, and still purchase property if you know what you're doing. I had a client, as a quick example, she owed like $284,000. They wanted off of this was pre the new regulations. They said, oh, well, your payments are $2,864 a month. we did a conference call with underwriting and Sally Mae or Navient, one of the two. I got them to state to the underwriter that the payment was actually only going to be $138. Big difference in debt to income ratio, and they were able to buy their house. There's a lot of loopholes. There's a lot of ways around it where the balance itself isn't as concerning as the monthly payment. So I wouldn't be as worried like, oh, let me pay the balance down. That's not as big of a deal as restructuring so that the mortgage company likes whatever your monthly payment shows up as.
Perfect. So Ariane has a question. We kind of touched on it, but I want to be crystal clear with this answer. He says, I was current on all my loan payments, but since the pandemic deferment, I've not paid any payments because they told me not to. Does this mean that my consecutive payments required for loan forgiveness has to start over?
No, it does not. So what's happening during the COVID forbearance is anybody that was on that path for forgiveness or whatever the case may be, 0 payments still count as a payment, and it doesn't have to be consecutive. So that verbiage isn't, accurate. It has to be timely.
Okay.
So timely payments is that, you've made on time when the payments were due, but, there could be times like, for example, let's say you work at a nonprofit for 3 years and then you take 2 years off to go to for-profit because you're like, oh, I'm so burnt out. And then you go back into the government, right? So those first 2 years at the nonprofit still count towards forgiveness, even though you took a 3-year break, and you'll come back and now you're starting at year 3. So it's not consecutive. It just has to be timely. And you have to make sure that you're in the right payment program. You got to make sure you're doing everything right as far as paperwork and all of that stuff. But yes, it'll still count.
Perfect. Tamiko has another question about refinancing the loans. Is it better to refinance the loans with a company like SoFi? And what are the best companies to what are the best companies to refinance the loans that allow forbearance as well?
No. Okay, I'm not going to talk bad about SoFi, but no. Okay, no.
This is what happens to people in the street. We don't know no better.
Okay, so here's the problem with companies like SoFi. There is, I would say, less than 0.001% of any client that I would ever recommend to go there. So, or any refinancing. And so keep in mind, when we talk about refinancing, here's what happens with federal loans. If you take a federal loan and you refinance it with SoFi or anybody else, you're taking a federal loan and you're turning it into a private loan. Well, what happens with private loans? It doesn't qualify for income-driven repayment. It doesn't qualify for forgiveness. It doesn't qualify for cancellation. It doesn't qualify for, God forbid, something else happens with another COVID and they give you 0 interest and 0 payment. It doesn't qualify for anything. They decide unless they want to be nice or whatever, but they don't have to. It's a private lender. You never take a federal loan and take it to a private lender unless under very specific circumstances. I had a client that I did do that with, but here's their situation. They were a New York attorney. They are making $250,000 a year. They didn't have any other debt.
Broke ass New York attorney then at $250 a year. New York attorney.
That was their first or second year in. Okay, I'm sure they're doing better now. They were literally fresh out of law school. They were doing very well. They anticipated continuing to do very well. They had no other debt. They were able to get a much lower interest rate under a private lender than the federal loans. It made sense.
Okay.
But anybody who thinks they're getting forgiveness, don't even think about it. Anybody who would like to get cancellation, forget it. Anybody who's not in that situation where they have a pretty set, long-term financial expectation, high expectation, I wouldn't recommend it.
Don't go public to private. I love it. Next question, I think, was directed at me. This is from my colleague, Uletta Gordon. I think she's asking me, do I feel the same way about bank bailouts as I felt about wiping out? Difference, I hate bank bailouts even more than consumer bailouts because the banks are supposed to be professionals. So they shouldn't get themselves in these conundrums. I'm not going to lie. I get a lot of flack. And it's funny, people who are listening to the program now who are always here may say, this doesn't even sound like Tank. Tank is always for the people. And I am for the people. I grew up on food stamps. I grew up around the corner from the projects. I grew up using all of the tools that the government gives you to get ahead. However, I do believe in personal fiscal responsibility. I tell this story all the time. Right before the housing crash in 2008, I had a group of professional athletes, because that's all I worked with back in 2008. We took a trip to Miami to meet with a real estate broker who was selling out a new high-rise building off of the Biscayne Bay. Beautiful condos going anywhere from 620,000 to 2.5 million. And every ball player is grabbing their condo. The guy comes over to me and says, "Tank, which one do you want?" And I laughed. I was like, "I can't afford one of these." He said, "What do you mean you can't afford one of these? We're giving," they were called ninja mortgages at the time, no income verification, no job verification, no asset verification. He said, "You just sign here and this condo is yours. Pick out the one you want." Now, mind you, big Tank with a condo overlooking Biscayne Bay and babes with bikinis, I would have loved to have that. I knew common sense wise, this doesn't make any sense. I can't afford, I got two mortgages already. I had a house in New Jersey and a house in Atlanta. I don't need a $700,000 condo. But somebody signed for that $700,000 condo, and then they were the same person on the news crying about predatory lending. I say, come on now, like, we got to be responsible to a certain extent. So when I think of bailouts for consumers or for corporations, I believe in moral hazard. Moral hazard says if you bail people out, you take away their culpability in the process, and then there's no dissuasion for them not to go do it again. So that's my soapbox on that. Now, the next question we have is from, I want to say it's Tashawana, asking about the IBR status. All of our student loans are in IBR status, and as a result, we don't have any payments until 2023. Can you help us?
Sure. So there's different income-driven repayment programs. Number one, I think it's important to know the differences. IBR is one of them, which is income-based repayment, but there's others. There is pay-as-you-earn, and there is repay. And do understand, a lot of people I talk to, they all say they're in IBR, and most of the time they're not. And there are differences to them. So anybody that has IBR, I would behoove you to log in and double check to make sure that that's what you actually have. And there's actually two different types of IBR. They try to make it as complicated as possible. They have the old IBR, which is going to be based off of 20% of discretionary income. And then there's the new IBR that's based on 10% discretionary income. Which one you got? There's a big difference. Right now, you have a zero payment, which means it doesn't necessarily matter in your particular case, but in some cases it will. Also, with the like pay-as-you-earn program has a little bit better benefits than like maybe repay. A lot of people get put in repay, again, going back to fraudulently mismanaging accounts. The government will just put you in repay. Oh, you want an income-driven repayment program? We're going to put you in repay. Well, they put you in repay for a couple of reasons. Number one, under repay, whether you file your taxes with your spouse or not, you still have to use your spouse's income. Ooh. Under pay-as-you-earn, you don't. So, if you file your taxes separately from your spouse, they don't exist, and you don't have to actually claim that, which could potentially, in certain situations, make your payment lower. They also have different stipulations if you have grad school loans versus undergrad loans. So that's important to look at as well. So there are some differences to the programs, and a lot of people don't realize that. There's like 8 different repayment programs, and they continue to make more of them because they realized the loopholes in the ones before, and they wanted to make it harder and harder. So you'll see a lot of people in repay that probably shouldn't be. It's not the best option.
I have a question we didn't touch on yet, and we've been talking about repayments, forgiveness, cancellations. So I know I just had to deal with this with one of my clients from the PPP loans, not to compare PPP to student loans, but it's going to end up being my question. PPP loans were given out, and almost everybody got them forgiven. Well, once they were forgiven, that's income from the government now, and now it's not a loan. And we have to deal with the ramification of reporting it on your P&Ls and things of that nature. How does forgiveness, how does cancellation, how does that work as far as the IRS is concerned? If you had a debt that got charged off, is that now considered something that you earned income on and you have to pay taxes?
It's a good question, and it's actually all treated differently. So each of the words, forgiveness, cancellation, discharge, are different.
Okay.
Public service loan forgiveness does not count against your taxes. You don't have to claim it as income. If you get discharge is where you were defaulted on your loans and they are sick of trying to fight you over it, and they've discharged all or a portion of them. Yes, you will potentially have to pay taxes on that. If you get forgiveness on loans that is not public service, because there is forgiveness, by the way, most people don't realize this, there is forgiveness for everybody else. You don't have to be in the public sector to get forgiveness. There's other qualifying factors. If you get forgiveness under that, yes, you will have to count that income. Okay. If the loans are canceled, I don't know how they're dealing with that yet. Okay. From my understanding, if they're canceled under this Navient cancellation, where it was these for-profit universities, from my understanding, they will not get taxed on that. If it's canceled for other reasons, maybe there's a new cancellation that comes out, I think it'll be a case-by-case basis depending on, I guess, whose fault it was or the reason for cancellation.
Okay. I feel bad for the word discharge. It just always gets such negative connotations, but we'll leave that alone. Let's talk about
thing. I had a client, we just discharged her. She owed, I want to say $270,000. We got about 170 of a discharge. I mean, yeah, you pay taxes on it, but guess what? You're not paying $170,000.
There it is. You can't be mad at that.
Right.
Nico asked a question about which nonprofits count for forgiveness. So when you get the public service, is it a private foundation? Is it, which ones?
So it's going to be 501c3s, and not necessarily all of them. There is documentation. There's employer certification forms that need to be filled out if you're not sure. So a 501c3, state government organizations. So those are going to be your main ones. There are some loopholes, like some daycares fall under that. It's always good if you're on the line or you're not 100% sure, there is an employee certification document. Have your employer fill it out. It goes over to the government, and then the government's going to tell you yay or nay if you're in the running to potentially qualify.
Appreciate that. My man Ariane just set me up. I was just sitting here looking at the clock saying we got 8 minutes left, and he asked a question that I'm about to say. So everybody in my audience, once again, we have more people here tonight than we normally have at 15 Minutes of Finance. And thank you all for attending. But my audience knows I'm real rap tank all the time. I give away money on my program. I always do what's right for the people. So trust me when I say this is not made up. Dr. Jen does not know I'm about to ask you this. But Dr. Jen, when you normally do a consultation for people and then, you get into a fee arrangement with them, how does that work? Because that's what he's asking. Once we contact you, will we be given an individual assessment? And then I just need you to give my people a break. Like anybody who's in this program, they need a coupon code for 10% off or whatever you want to do. And I'm putting you on the spot because it's all love. But the people from the Financial Power Hour need a break on the rate. And I promise you, I'm going to keep bigging you up everywhere I go to get people in your office.
You know what? And look, I'll make a deal with you. If you give everybody a break and let their loans be canceled and be happy about it, I will give all of your people a break, okay?
There it is. I can't be bad no more.
You love capitalism, but that was a very socialist question, right?
I'm going to stop being a Black Republican and being so hard on our people. Forgiveness for everybody. What the hell?
But to answer your question, so number one, the process is they do a free call with me. We discuss, what their needs are, if they even qualify for anything, or if there's adjustments that they need to make. Based on that adjustment, we have a couple of different payment arrangements. There's different service pricing. It could be, for example, those that feel like they should get public service loan forgiveness. Maybe they didn't, qualify before, but under the new waiver they do. Right now, we have that discounted as $695. That is actually a discount. Yes, it's a lot of work. We do a lot of fighting. But so right now that's $695. somebody who's in default and we have to go in and actually deal with lenders and try to get settlements, that's a $9.95 charge. And then we have some services that are less depending on what it is. So that's kind of a range. So I would say anywhere from like $450 up to about $1,000 is kind of the average. I would be happy to discount everybody 20% that does sign up. I will create a discount code specifically for you so that way you can share that with everybody. Anybody who uses that code will automatically get that discount. And then of course,
that's why it's love. First of all, when I rubbed the magic lamp and asked the genie, Dr. Jen, to appear, she said yes with no problem, no hesitation. So thank you very much for bringing all of the knowledge you brought to the people. Even if if people didn't have 50 cents in their pocket, they got thousands of dollars of game and knowledge tonight. But I know my audience will call you up, go through your consultation process because they're trying to increase their net worth. And They realize that the drag that student loan debt is, and I do agree with you, it's not going to be a magic wand waved and all of a sudden nobody has student loan debt anymore. So going through this process, I will get the discount code to my people. I love you for doing that. That's big. I was thinking 10%. You said 20, and that's why I rock with you.
Yeah, so, let's just bump it up. Make it worth their while.
Yeah. So please tell everybody. Now I got Tasha Wana, who always shows me love. It's my sister from Temple, who puts information in the chat for everybody. Renee's been putting your contact information in the chat. But just real quick, tell everybody, we got 4.5 minutes left, where they can find you and how the process to reach you works.
Sure. So I'm everywhere on social media. So if you're on social media, you're bound to see me. And I like to be very personable. So you're welcome to hit me up on my personal social media account, which is Dr. Jen, one word. So DRGEN space Dobson. That's my Facebook. That's my TikTok account. And that is my Snapchat as well. And then as far as scheduling a call with me, I do have a couple websites. One of them, which is easy to remember, is going to be studentloanmanagement.info. And by the way, there's no hashtag in that. Just okay. But yeah, so studentloanmanagement.info. If you go on there and you click on contact, and you can schedule your appointment at a time that's convenient for you. Like I said, that is a free call, so that's a good way to reach me. You can also go in there, shoot me an email, and ask me a question if you have something simple that you just want to find out about. So I'm pretty much everywhere. Google me. If you just Google Genevieve Dobson, I'm sure you'll find me there. And then, of course, check out some of the reviews on Google. If you type in Degrees of Success, which is the name of my company, I'm out of Tampa Bay. You're going to see a lot of reviews of people that have worked with me in the past. So.
Perfect. And that is the best way to wrap the show tonight. It is a privilege and an honor. Somebody did come in with a late question, and we answered it, but I want to just reiterate the answer. Good Cat, the Sports Life on YouTube said, do you renegotiate balances with Navient based on their fraudulent practices?
Yeah, it can be. Yeah. So it depends on the situation. Every situation is different. But absolutely, I have worked with them a lot on a cancellation or discharge of student loans. And now that they have been proven to be officially fraudulent, that's a very good fighting power. I've usually been able to get it even without that. But yeah, we can definitely negotiate. I've negotiated hundreds of thousands of dollars off the balance, literally. So yeah, we can negotiate. We can make something happen. Generally, though, just keep in mind, a lot of that happens on the private side, or it happens because of defaulted loans. They're less likely to negotiate if you've been paying on time, obviously, right? That's lenders, most credit companies, but there's always negotiating and settlement opportunities.
There you go. So I told you an hour will go quick. I don't want to say goodbye, but I know you got other problems to solve, other things to cure in the world. We will definitely have you back later in the year. Please come back and visit with us. And as we tell the people here, every time they come tune into Wealth Our Way, wealth is not only for the wealthy. We will see you. I'll be back tomorrow at 12:30 Eastern on 15 Minutes of Finance. to wrap up any questions that come up about student loans. Dr. Jen is always available with me via text and chat to hook that up. So I will see you guys tomorrow, wrap the program up, and then to talk about next week. So thank you guys. Have a great evening. Thanks, Dr. Jen.
You're welcome. Thank you. Bye.